Hello, ladies and gentlemen. Greg Mikulowski, and this is a daily Forex report. Today's date is July 3rd, 2014. I'm going to talk about the unemployment. I'm going to talk about the ECB, and then I'm going to take a look at some of the major currency pairs from a technical perspective. All right, let's start with the ECB. The ECB kept the rates unchanged, and Draghi had his press conference, talked about moderate growth in the second quarter, said that inflation expectations were firmly anchored, said there's a downside risk to the economy, said that unemployment is still too high, said that the ECB was going to change their meeting frequency to 6-week cycle. That's interesting. So that's good news for the market, I think, because it won't be on the unemployment week anymore. It's going to be on a different week. Well, the potential is that it's going to be on a different week, at least every other time. So that's good for traders who look for that volatility off of things like the ECB, off of the employment report. He also said that they're going to intensify the prep work related to the ABS purchases. Those are asset-backed security purchases, leaving the door open for potential QE down the road. But there's a lot of work to go with regard to that. But he did say they're intensifying that work toward that end. He did comment about the currency, saying that they're monitoring it, that it has an impact on inflation, but he didn't come out outright and try to talk the value of the euro to the euro down. And so in that respect, he was a little bit more neutral than what I was hoping for. I thought he might be a little bit more dovish, but with his comments. But well, the unemployment report allowed for the dollar to get stronger, the euro to get weaker, and I would characterize the U.S. unemployment report today as being pretty solid. 288,000 jobs created. We had a revision of 29,000 to the prior months. We saw the unemployment rate move down to 6.1% from 6.2 or 3% last month. We saw the average over the last 3 months of non-farm payroll jobs go up to 265,000. As they added 288,000 this month. The 12-month average also moved higher to 206,000. The average of 2013 was 194,000, so moving in the right direction. The bad from the report, or the less good from the report, is that the participation rate remained low at 62.8. The concerns that the people are leaving the labor force, and if they do decide to come back, that would be a drag on the unemployment rate, that more people would be in the workforce, and as a result, the unemployment rate would move higher. That's been the concern. The other negatives from the report are the duration of unemployment, although it's trending to the downside and reached its lowest levels in a number, since 2008 or 2000. What does it look like? 10 or 9. It still remains high historically at 33.5 weeks versus a pre-crisis level of 16.5 weeks. The other negative that analysts keep on harping on is the amount of temporary jobs being created. 12.3% of the total jobs created since the job recovery began are temporary workers, and this is you'd rather have those workers working full time. So overall, the job report was solid, but there's always going to be those naysayers or whatever who say that there are some negatives still within that report, and that keeps the Federal Reserve on hold going into the future. So let's take a look at some of our currency pairs. I'm not going to start off with the sterling versus U.S. dollar. I'm going to start with the euro versus U.S. dollar. This is a daily chart, and the daily chart shows that the price has moved below this trend line. This trend line comes in at the 136.13 level, and the market fell below that level and has corrected a little bit above that level since the report, but currently is below that level at 136.07. The market is finding some support around the 136 level. If I go to the 5-minute chart and put in a horizontal line around the 136 level, you can see here how the market moved initially below that level, went down to a low of 95, and over the last 3 or so hours have been able to stay above that 136 level, and that is now digging itself in as a support level for the euro versus US dollar. On the top side, the corrective move, remember that we have the 14 level where that trend line comes in. But I put a Fibonacci retracement here from the high to the low. And if you measure the 38.2 to 50% retracement level, that's this yellow area right here, the market's been able to stay below that level. That says to me that the sellers are remain in control. Why? Because when the market corrects, the sellers have been coming in and selling it. They sold it here, they sold it here. And so traders who couldn't get in on the short are happy to get in on a correction toward the 38.2, toward the 50% retracement. It's when the market moves above the 50% retracement that I get a little bit scared. Then I start to think that these sellers right here through here are starting to think about buying or covering their position because it moved back above the midpoint of that move. It just is more, it becomes a point of pain when the market starts to move above the 50% retracement level. And so you don't want to see that happen. You want to see the sellers remain in control. That is, control is important. And you show control by staying below the 38.2 to 50% retracement. That's what I think. That's what I look for. Let's look at the dollar versus yen next. And if again we start off at the daily chart and we look at what where we're at and what we've done, the market moved sharply higher off of the better data. The dollar got stronger. It moved above the 100-day moving average, moved above this topside trend line, and trying to remain above that topside trend line and the 100-day moving average around the 102.16 level. Currently trading at 102.17, so we're not that far away from dipping back below it. But again, like the euro versus US dollar, I like to measure the 38.2 to 50% retracement of a trend-like move. And if we put a Fibonacci retracement on this chart right here, I'm going to zoom in. So here's the sharp move to the upside. The corrective move to the downside remained above the 38.2. So that's positive for this pair. This is a technique that I like to use. So maybe you could try it yourself. But as long as the price remains above this correction zone after a trend-like move, correction, buyers enter. Who's remaining in control? The buyers are remaining in control. They still have to get through the double top up here at the highs. It doesn't necessarily mean that the market's going to not roll over and come back down below the 38.2 to 50% retracement. But this is my area where I want to see buyers come in, where I want to be a dip buyer against. Come down here, buy it here, put your stop right here. All right, low risk, reward, potential reward, take out the highs. That's the way I look at it, folks. That's the way you look at it. So far, the dollar versus yen holding 38.2 to 50%. Have some trouble up here at the double top. We need to get through that. If we're able to get through that level, then we start to move up toward the high price that we saw in June that came in at 102.78. That would be our next target. Also have this trend line coming off of highs here. That's going to come together somewhere around that 102.78 level in next week's trading. So good resistance up there, but that's where we would be going for the dollar versus yen. Now let's take a look at the sterling versus US dollar. And here on the daily chart, we broke above this trend line in yesterday, actually not yesterday, the day before's trading, and we stayed above it there, and yesterday we moved a little bit higher. Today we actually came down below that trend line at 171.26 today on the employment report, moved a little bit below that level, but as you can see, we're back above that level. So the selling in the sterling versus US dollar did not continue. We found the buyers down below, the market moved higher. Now let's go to the 5-minute chart and do that same routine that we did on the euro, that we did on the dollar versus yen. Put a Fibonacci retracement on the trend move to the downside. So here the market moved down and then moved down again, and put a 38.2 to 50% retracement. What did the market do off of the bottom after we broke below that trend line at what, 26 level, right? The 26 level was that trend line on the daily chart. We came up to that 26 level, which also happened to be the 50% retracement level. The market came off a little bit and then broke back above that 26 level, and that's what caused the market to move to the upside. So this 38.2 to 50% retracement level is important. It gives traders an idea of who's in control and where that control switches from buyers or sellers, in this case, to buyers. And the market was sold off here. But once it moved back above that 50% retracement, those sellers became frustrated and they started to buy up, and as did new buyers come in, and the market moved higher off of that level. So there you have it, a look at the employment report, a look at some of the major currency pairs. If you like this video and want to see more, click subscribe on this YouTube channel right there, that button right there. And if you want more information on trading Forex, visit me daily at gregmikefx.com. Finally, wishing you all a happy and healthy and safe July 4th holiday for those people in the United States, those people overseas. Have yourself a great day as well. Good Friday and good weekend. My name is Greg Michalowski, and this has been a Forex commentary brought to you by Greg Mike FX. Bye-bye now.